My name is Michael Gayed, publisher of the Lead Lag Report, joined there to Gary Brode, returning champion, Gary Brode. Gary, for those who are not familiar with you, introduce yourself. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Thanks, Michael. Thanks for having me on again. I appreciate it. And everyone else, thanks for tuning in. I have a 30 plus year background in the hedge fund business. I worked for some of the big ones and ran a couple myself. And then in January of 2020, I took the same methodology that allowed us to turn out market beating returns, generate a lot of alpha, very high probability, high return stock picking, and started deep knowledge investing. We work with hedge funds, family offices, registered investment advisors, and individuals like yourself, and we help them get better returns in the stock market. Some of what we're doing is macro, some of what we're doing is hedging, which is certainly important at this point in the cycle. And then the core of what we do is really just go to old bottom-up, old-fashioned stock picking.
All right. So I changed the name of the space from when the bond vigilantes returned to junk to talk about this idea that the Fed hiking rate actually, oddly enough, be inflationary. Now, that's something I myself have brought up in the past when we read this down, because if you hike rates and you tell the market you're hiking rates, that might create bump in the velocity of money. People start expecting the cost of capital is going to rise, so they actually spend sooner, and that creates a self-reinforcing inflationary cycle. Maybe that's part of your theory, maybe not. But I want to hear your thoughts on how the Fed may actually be doing it to themselves, so to speak.
Yeah, Michael, I actually think you have the situation nailed. Your description is terrific. And one of the things that we've been pointing out at Deep Knowledge Investing for the last 2 years is that people have misunderstood what's going on and blame is being placed in the wrong place. So over the last year and a half, there have been all these screams that Powell's destroying the market, he's killing things. That actually wasn't the error of the Fed. The Fed's error was holding rates at or around zero for more than a decade, combined with $9 trillion of quantitative easing and trillions of dollars of mortgage-backed securities they're not allowed to hold, which warped the housing market. And that's a huge chunk of your CPI right there. So it was actually the Fed's actions before the last couple of years that created the inflationary problem. At that point, Powell had no choice but to raise rates. And I don't think he was wrong for it. And in fact, I think he should have raised rates a lot faster, a lot harder, and a lot sooner. And the reason for that is at this point, what's creating inflation is not actually the Fed's actions, it's congressional overspending. And we saw that this round of inflation got kicked off by massive amounts of the government just spraying money into the economy. And that's what caused the inflation. And so, we have a situation right now where Powell and the Fed, the instrument that they have are rate hikes and reversing the quantitative easing. But what they can't do is they can't stop Congress from overspending. And so where we are on this is we just had this supposedly big, bitter, horrible 6-7 month budgetary fight where everybody was shrieking that it was going to be the end of the republic and our government is non-functional. And everybody who's been through this a million times before came to the same conclusion I did, which is it'll all be fine. They'll come to an agreement and that agreement won't involve spending cuts. And everyone in Washington is dishonest about this stuff because what happens is there are expectations that over the next 10 years, we're going to increase spending. And in this case, Kevin McCarthy and the Republicans came in and said, it's too much spending. We want to cut spending. We're going to slash spending. And Democrats said, oh my God, it's terrible. They want to kill people. No one will have health care. This whole it was like watching a ridiculous soap opera where there were really no stakes. Because in the end, all of these horrible draconian cuts that McCarthy supposedly negotiated simply meant a small decrease in the rate of increase of spending, right? So we're back to our high school calculus. It's a second derivative calculation. And so the agreement that they came to, and this is just a few months ago, was that Congress was going to overspend on balance sheet by $4 trillion over the next year and a half, 2 years, something like that. To that, we need to add another maybe $6 trillion a year of off-balance sheet liabilities for total excess spending of ballpark $8 trillion a year, all of which will need to be monetized. And now we have a situation, we've all seen that graph. And Michael, I know you have a copy of it. Maybe we could throw it up. But the graph of U.S. interest expense. And that's skyrocketed. A decade ago, it was $400 billion. Just a few years ago, it was $600 billion. We're now past $1 trillion. And that's without the impact of higher rates making their way through the government balance sheet. And so what we have now is a situation where Powell has completely lost control of inflation because it's being driven by congressional overspending. But more rate hikes will simply mean more interest expense. We are now over leveraged with more than $33 trillion on balance sheet. And so just the excess interest spending on the extra spending this year alone is going to be $100 billion. So we're going to see that $1 trillion of interest expense trending over the next few years to more toward $1.6 to $2 trillion. We add that to the additional $4 trillion, and that's really the issue right now. It's that the Fed has lost control of the situation, and Congress, both parties, have made it crystal clear that spending less money and trying to be more fiscally responsible is not even an option they're considering.
Okay, so a few things. One is, I can't imagine, maybe I'm wrong, I can't imagine that those in Congress, sitting in Congress, they're not aware of just how dire the situation has become. Is this willful? Is this ignorance? Is this one of those things where, well, you know what, by the time it matters, maybe they'll all be dead from old age? What's really driving sort of the thought process here?
So I think it's a combination of things. First of all, let's not forget Hanlon's razor, right? Like, if given a choice between incompetence and stupidity, unless the arrow definitively points to incompetence, we're most likely looking at stupidity. And the truth is, the vast majority of Washington is fiscally illiterate. They have no idea how the economy that they run works. And that was fine decades ago because the government's role in the economy was smaller. So their financial incompetence didn't really affect our lives so much. But every year, the government is spending more. They're taking control of a larger and larger part of our GDP. And so their ignorance of how an economy works, how their spending works, how inflation works, it not only doesn't exist, but it creates more problems for the rest of us. I think a second part of it is you and I, we're a little bit older than maybe some of the people on this call. And we have this sense of we elect good people to represent our interests, that Schoolhouse Rock version of government that we all got to sing along with from the Saturday morning cartoons. And that's a great model. But the truth is, most people in Congress are not really that interested in the American people. They're not really interested in their jobs. What they're interested is in keeping their jobs and the benefits of it. And so if we go back a few decades, there's a rule of thumb was the Democrats wanted to be the Santa Claus of entitlements. We're going to give you lots of free stuff. And the Republicans wanted to be the Santa Claus of tax cuts. Hey, we're going to make sure you have more money in your pocket. You don't have to send money to Washington. And you've had these competing interests where you could tie bigger government and more spending to a bigger tax bill, and people could understand who they should get angry at. And Congress has discovered the same thing that ancient Rome did, which is debasing the currency. And so the current plan actually does not involve acknowledging more spending. It doesn't involve taxing people. The current plan involves Washington being the Santa Claus of everyone and everything all the time. And so what we're seeing is that rather than run their spending through a normal budgetary process and taxing people and having people say, okay, I'm willing to pay for this. I think this government is worth funding. Or saying, are you kidding me? I'm paying this much and the government's doing this. We need a smaller government, where there'd be a conversation about it and where people would understand who to be angry at. What they're doing is just debasing the currency. So over the next couple of years, they'll spend in excess $4 trillion. Again, add to that the off-balance sheet spending, the extra interest expense. We're going to be spending an excess of somewhere in the neighborhood of $10 trillion a year every year. But we're not going to tax people for it. What we're going to do, what Congress is going to do, is they're going to monetize it. They'll run that debt, they'll add to the debt, and then the Treasury Department will issue it, and we'll just create more currency units. And the reason Congress loves inflation is they can blame everybody else. So they could print another $5 trillion of currency tomorrow, spray it around the economy, have inflation. What are they going to do? They'll blame the greedy corporations. Because as we know, companies somehow weren't greedy a few years ago when inflation wasn't a problem. It's the ability to point the finger and blame somebody else that Congress is interested in. And I think we all know that if somebody comes back and says, okay, hey, constituents, here are your choices. We can cut government spending and you're going to get less stuff, or we can increase taxes and you'll pay higher bills. Michael, what happens to that person? Do they get reelected?
Good luck.
Exactly. So, and part of it, listen, I am always going to be on team and the Fed, and I have no problem blaming Powell and the Fed for the mistakes they made over the last decade and a half. And I'm very critical of Congress, both parties, because this overspending is obscene. And we're all paying for our stimmies. We're just paying for it in a higher cost of living. But let's all take a minute and look at ourselves. And as Americans, we bear responsibility for this too, because we keep electing people who don't have our best interests at heart. And we've set up a situation where any individual member of Congress, if they were to do the right thing, we won't reelect them. And that part is on us as well. Now, should members of Congress act with greater knowledge and greater integrity? Should they educate themselves on finance and the economy that they have a huge impact in? Of course they should. But the part that we as American citizens are responsible for is we've put them in a position where if they do the right thing, like you said, good luck, you lose your job. We're going to elect somebody who promises us more or agrees that we won't have to pay for it. And one of the things that I thought was really interesting, and I've got a piece coming out of this later this week, is if you look at the election in Argentina, and you know how much I love to look at other countries' fiscal situations. One of their candidates for president offered no taxes. Not the old President Bush promise of no new taxes. He said no taxes. He also didn't offer to cut spending. So basically, what the leading candidate in Argentina is promising is we're going to offer you guys lots and lots and lots of government services, big government. No one will have to pay for anything. Well, the way that works is they issue debt and Argentinians pay for that in inflation and they're accustomed to it. And for the people who maybe aren't so familiar with it, the inflation rate in Argentina has been over 100% for years. It's currently somewhere in the neighborhood of 120 to 140%. And try to imagine that here. And the reason I suggest that is not because I think the CPI is going to 100% in the next few years. That's ridiculous and isn't going to happen in the next couple of years. But it is the direction that our US Congress is heading, right? We're just going to pay for things with issuance of currency units that we're going to pay for in inflation. And a lot of people just won't understand why their quality of life is declining, why things get harder and harder, why it's harder to pay their monthly bills every month. And this method of paying for things allows Congress to blame everyone but themselves.
Okay, now we have relatively high compared to history, positive real yields. And one of the long-held arguments is that because this government debt keeps on rising, because government spending keeps on rising, the government needs negative real rates. And that's the only way to somewhat eat away, at least, in nominal terms, against that debt. Are we going to go back to negative real rate? Just because that seems to be the only way to somewhat fund this, or will those positive real rates stay? And if they stay, does that become an incentive for them to try to slow things down and stop?
Yeah, that's a great question. And I completely agree with your analysis on this. We need negative real rates, even though it's horrible and not advisable, right? Negative real rates it's a good save and invest money and receive less purchasing power back, right? And these kinds of things, they kill investment, they kill GDP growth. So we're all going to end up much poorer because of it. And as we've all seen in the last decade, when we have negative rates, all kinds of stupid things get funded because people are desperately looking for yield. And so the reason you're right and that we need negative real rates, even though I just explained why it's a horrible value destroying thing, is because the real liabilities of the US government are 33 trillion on balance sheet, which, as we talked about, is going to do nothing but grow. Nobody in Congress is even thinking about reining that in. Plus, we have another 200 trillion plus of off balance sheet liabilities. Those are things like Social Security, Medicare, Medicaid, pensions, promises that we've made to our people. And so it adds up to somewhere in the neighborhood of $250 billion. Michael, there is no level of production, GDP growth, taxation, or asset confiscation that results in $250 billion of value being created. And so what we're going to have to do is print more currency, devalue the dollar, debase the currency, and we'll pay those obligations, but we're going to pay them in currency in fiat that simply isn't worth much. And it's what I've called a stealth default. We won't officially default because we can produce dollars, but we're going to pay people back in dollars that are so debased that they're not really getting value. It's technically not a default, but it's not honest either. And so that's why I've been calling it a stealth default. The one thing that I would point out is you were talking about real interest rates being on the high end of the range. I'm not sure I agree with that. If you take a look, and I know I sent you a copy of Counterintuitive Inflation. For people who want a copy of that, it's the pinned post on my profile. You can download a copy for free. We're not charging for it. But if you look at page 9, I have a long-term graph for real interest rates. And real interest rates right now are somewhere in the neighborhood of 1.6%. And that's assuming you believe the CPI. I don't. If you think the CPI is understated, that 1.6 number is probably high. Real rates right now are probably close to 0, 50 basis points, something like that. And so I don't know that we're high, on a basis. I don't agree with Chairman Powell when he says we have a restrictive rate. We have a real rate that is just barely above 0. And Congress is spending like they're trying to get us out of a depression or into a war. And I had no idea how that's going to work when all this makes its way through. Like, we've never seen a situation before where we had 0 rates at the top of an interest rate hiking cycle. And we're probably near the top, at least for right now. That's what they're telling us. But also Congress overspending by $2 trillion a year, right? This is the kind of program that you'd see when we're trying to buy our way out of a Great Depression or get ourselves ramped up to fight World War II. So they're blowing all their dry powder right now to the extent that anything we have will be considered dry powder.
How is this dynamic different from what's happened with Japan? Yeah, okay, they're dealing with inflation now, sure, but all that government debt ends up being largely disinflationary or deflationary because the central bank has to buy it up. Nobody else is willing to do it. And they haven't had inflation for a while. What makes the U.S. trajectory different?
Yeah, so Japan is a really interesting situation. Their debt is even worse than ours at somewhere in the neighborhood of 260% of GDP. This is something you and I talked about in one of your Twitter spaces a year ago. And the way that the Japanese government has been able to keep insanely low interest rates, just a year ago, I think their 10-year was trading somewhere in the neighborhood of 20 basis points, 25 basis points. And twice they've thrown in the towel. And last time I looked, the 10-year was trading at something like 85 basis points, which is it's a big increase. But the problem that Japan has right now is, one, they have no price discovery in the markets. In the US, and we can talk about the bond vigilantes, but in Japan, it's the Bank of Japan that owns the vast majority of their debt. I mean, we had a week, not last summer, the summer before, where literally the only buyer in the market was the Bank of Japan. The other issue that Japan has is they have been willing to accept a massive hit to the yen. And so what we saw last year was the yen went from about 100 to the dollar, 110 to the dollar, something like that, all the way down to 150 to the dollar. And that is a crushing hit, especially, again, for a small island nation that has to import a lot of natural resources and import most of their energy. And so what we're going to see in Japan is an increase in inflation, and the Bank of Japan is going to be stuck in a situation where their choices are either going to be to protect the low yields and have their currency devalue, in which case their imports are going to become very expensive and they're going to start seeing worse inflation there after years of not. Or they can do the same thing our Federal Reserve is doing. They can raise rates and then create the exact same problem, only Japanese debt as a percentage of GDP is worse than what we have here. And so they'll blow out their budget even faster.
I think you hit it correctly. It's the currency side. What makes it different, and which is why the shell game continues, is because we still have that reserve currency status. So they get out of the yen, they go into the dollar. If you get out of the dollar, where you go?
Yeah, that's exactly it. And so what we've seen, and people have talked about this a lot, the dollar carry trade, where people were selling yen and buying dollars because the dollar had a higher yield. And that's fine. Japan's been able to do that. But let's just take a minute and just stop and think. Because people, you're asking the really smart question, which is, wait a minute, we're looking at similar conditions in Japan, but there are differences. And the huge difference is I want everybody on this call to imagine what would happen in the United States if our currency were to fall 50% against the euro, the pound, the won, the yen, right? Especially for a country like ours, where we import as much as we do, where we're net consumers of foreign goods. And now try to imagine inflation if our currency were plummeting against everybody else's. People would go absolutely bananas. The Bank of Japan has been able to do that in Japan. They simply have a different relationship with the yen, at least as of now they do.
You don't want to see that dynamic in general. You definitely don't want to see it in a country where there's the right to bear arms.
I don't want to start turning into some sort of threat or anything like that. But I do agree with you. There's a level of financial difficulty, a level of inflation, a level where people have lives that work, and then all of a sudden they're working hard and their lives don't work and they can't pay their bills. And when something like that does happen across an entire society, there's always the possibility of unrest. And we've seen that. And there are all kinds of studies that show that the more free a society is, the more prosperous society is. The more prosperous a society is, the less violent they tend to be. And I'm sure everyone on this call can come up with the exceptions that prove the rule, but that's generally the way these things go. And so imagine a scenario where the dollar were to drop 50% and the price of our imports were to skyrocket, or the CPI, instead of us going crazy because it's at 9%, and I think that was understated, but what if the CPI were to hit 50%, 60%, 80%? At some level, you do start dealing with domestic unrest. And while I will never advocate for violence or say that it's wise, it's not something that I ever want to see happen. You can certainly understand the potential anger of people who have a life that works and they work hard and they really just want to go home, spend time with their families. And all of a sudden they can't pay their mortgage. They can't pay their car payment. They can't pay for groceries. And you and I often deal in the world of financial abstractions. And the way you make money is by putting your emotions aside and looking at the data and drawing the right conclusion. But anytime you step away from it, all the things that you and I deal with on a daily basis, these affect real human beings in their homes, at their kitchen table, and their lives. And you can't trade thinking about it, but you can't be a human being and not think about it on occasion.
Let's get into the bond vigilante discussion for a little bit here. I keep hearing that line, bond vigilantes have come to the U.S. government. To me, that sounds a little odd. The ultimate bond vigilante, if that's the case, is the Fed, and the Fed is still part of the government, even though they're supposed to be separate. This whole narrative of bond vigilantes, is it misguided? Is it accurate? How do you think about that as a framework to think about what's happening in government debt?
Sure. Well, let's just define the term first, because bond vigilante sounds very notorious. It's a sensational term. And there's this sense that it only applies once a generation, once every 50 years, something like that. What I'm referring to when I talk about bond vigilantes is simply the unwillingness of a bond market to continue to buy at a particular price. And as half of FinTwit has pointed out in the last couple of weeks, we have basically a yield will fix demand problems. And that's what we're seeing. The government is issuing more and more debt. We've got these massive treasury auctions that have come. And the bond market has said, we're not buying it at this price. And since the last time the Fed raised rates was 3 months ago. And they raised 25 basis points 3 months ago. In the 3 months since then, the yield on the long end of the curve, the 10, 20, 30 years, up approximately 100 basis points. Again, you and I know it's volatile. It moved 20 basis points yesterday. Depending on the day, it's up about 100 basis points. And so yield is the thing that solves this. There is a yield where the bond market will buy. But when the bond market is really just unwilling to buy at what people think is the current yield and say, we're not going to buy more until you lower the price and we get a better yield, we're referring to them as the bond vigilantes. And, the term makes it sound like they're bad guys, they're bad people. Oh my God, vigilantes. Is it Batman? Is it financial Batman? But the truth is, this is something that provides necessary discipline to the market. Our government should not be able to issue unlimited debt at no cost with no consequences, because the truth is, we're all going to have to pay this back sometime in the future. One of the things that people forget is the debt we take on now, that's not investment. That's not money that's being saved. It's not money that we're using that will create future economic growth. All we are doing is pulling tomorrow's demand forward. And so when we get to tomorrow, that demand will still be there, but the goods won't. And either older versions of all of us on this call, we're going to have to pay for that, or children or grandchildren will have to pay for it, right? It doesn't make these obligations disappear. And so the bond vigilantes provide much needed discipline to the market. And the signal that they're sending lately is we want better pricing and higher yields. And to me, there are two ways to prove that the bond vigilantes are in control. One is the one that I just pointed out, which is the Fed has held firm for 3 months and indicated to the market, we're done hiking for now. And I think they are. He's given very accurate guidance for the last 2 years. He's told us all what's coming. The market hasn't always believed him, but he's told us. And so, when we see the long end of the curve going up 100 basis points, which, as you well know, is a lot on not only flat Fed funds rate, but also an indication that's not going up in the future, or the near future, rather. That's one indication the bond vigilantes have taken control. But here's the other. Let's go through a thought exercise together, because I know this is something you think about, Michael. Let's imagine Powell were to come out tomorrow and say, okay, everyone, I was wrong. I over-tightened. We're reducing the Fed's fund rate by 100 basis points tomorrow. Michael, what do you think happens to the long end of the curve?
It probably does rally, but maybe not, because it's ultimately about what is the implication then on the market's inflation expectations. So I think there's a nuance in terms of how to think about the kind of direction it could go.
Yeah, so it's the latter point that I'm focused on. And you're right, bonds could rally the next day. But I don't think it'll take very long before people start to realize, wait a minute, we've got Congress overspending by trillions of dollars a year. They're flooding the market with debased fiat dollars. And the Fed reducing rates, all of this is going to lead to future inflation. And I actually think the bond market would read that correctly and start to demand higher yields at a lower Fed funds rate right now. So that part can't be proven right now. It's speculation, but that's my view on it, on why I'm saying the bond vigilantes have taken control and the Fed doesn't have control. And we're all going to keep watching Jerome Powell's press conferences, and we're going to keep reading the press releases out of the Fed, because of course we will. But I think at this point, the real news in inflation and bond rates is not going to be driven by the Fed. I think it's going to be driven by congressional overspending and by, in this case, the bond buyers, or the bond we're not buying until you give us better rates, people who we're referring to as the bond vigilantes.
Doesn't all this matter more for Europe than the U.S.? Their fiscal situation across the different countries is, I think, uglier than ours.
Yeah, absolutely. And I think you and I talked about this a year ago. I think these issues are going to move from east to west. And I'm just talking about kind of the Western democracies. China is a whole other category themselves, and that's complicated. But at the moment, Japan is in more trouble than anyone else. The U.S. government currently still has the world's reserve currency, and that is buying us time that we're not using to fix the problem. In between those two, I completely agree with you. I think the EU is facing a lot of problems. They're leveraged like we are. From a cultural point of view, they have been heading toward lower levels of production and less work from their employees, from their workforce for decades. It's just, the European, their sense of quality of life. But the problem is, as France is finding out, the math doesn't work when you're funding people for 30-year retirements. It just doesn't work when you have people who decide they're going to stop working and the rest of society, the rest of an aging society, is going to fund these people on the government dime for more than a quarter century, for a third of a century. It simply doesn't work. They don't have the economic growth for it. They may not have the energy resources for that. They are dealing with cultural and immigration problems there that exceed what we're seeing here in the US. And that's creating problems. And the other thing that they have is, I get what they were thinking when they started the EU, right? It was, wait a minute, we can take Italy and Spain and Greece and we can put them on Germany's credit rating. Well, it didn't quite work that way. And the German people at some point are going to be tired of funding retirements in Italy and Spain and big government handouts in those countries. And so I think you're right. We're going to see economic problems there. We also at some point may start to see the world go to smaller units of government. And I don't necessarily think that's a bad thing. When people talk about the breakup of the EU, it's always with this sensationalist, oh my God, this is a terrible thing, and democracy is failing, and the world is failing, and our government said, no, there's actually nothing wrong with having Italy manage Italian interests, and Spain manage Spanish interests, and Germany managing German interests. I don't know that smaller units of government make for greater injustice or bigger problems. I actually think the closer people are to the people that they're governing, the better result that you get. And so this could happen. And from an economic point of view, it may not be great. But from a political point of view, they could end up with an okay result there. So let's separate this out into two pieces because you were referring to both ends. And I think it's important to clarify. So there's the real world, and then there's the government accounting world. And I've said for years that all government statistics are lies. They do not present reality in any way. They simply support a government-preferred narrative. And the best proof of that is we see all of these numbers are constantly adjusted, and then they're constantly revised. It's basically, we'll tell you what we want to hear, but it's not really what it is. And so one of the things that I think has surprised people is, look, a year ago, everybody was saying, oh my God, we're going to have this horrible recession. And in fairness, I acknowledge I was one of those people who thought we did have a recession last year. I don't care what the agency, the political agency that designates these recessions, right? Last year, we did have a recession. We had 2 straight quarters of negative GDP growth. They can massage it any way they want. That's a recession. But after that, we had a lot of people saying, wait a minute, this is going to get really bad. And a lot of people were saying, okay, wait, we're going to have the recession in 2023. Now people are saying, okay, we're penciling in the recession for the first quarter of 2024. Again, mea culpa. In fairness, I certainly thought that things would be worse than they are right now. And we've seen all these conversations. We saw hard landing going to soft landing. Now people are thinking no landing, no recession. What's going on? And the answer to that is government spending is additive to GDP. And to give you a sense of how completely ridiculous this is, Congress could pass a bill saying we're going to spend another $1 trillion on nonsense. They could label it the nonsense bill. And they could literally just hand out $1 trillion to people. Or the old example is you pay half the country to dig dishes and the other half of the country to fill them in. That non-activity, that waste of activity, because it's being done by the government, is actually additive to the GDP. So if Congress were to authorize $1 trillion of hole digging and hole filling, producing no value at all, we've just increased GDP by $1 trillion. Now, are they lying? No, that's the calculation, but the calculation is inaccurate. And so the distinction I would draw here is the distinction between economic activity and production, GDP versus production. Right now, I think the reason we're not in a recession is not because Powell got lucky or Powell did the wrong thing or the Fed this or the Fed that. I think it's because the government is still spraying trillions of dollars of excess spending into the economy. Again, this is the kind of spending that we would expect to see if we were coming out of a Great Depression and you were a Keynesian, or what you'd see if we were ramping up for World War II. Again, this is the kind of spending in those moments. And that's additive to GDP, but it's not creating value. And so what we have is a really weird situation where our GDP is positive, the economy is good, but we're paying for all of this through current and future inflation. And it's why people are having more and more trouble making ends meet. And that's the problem. The second part of your question that I think is really important to address, you brought up the issue of, is COVID spending different? And the answer is yes, and I'll clarify why I say. Saying it's different implies that something different has happened. I actually think you're right, but I think the truth lies outside the bounds of this discussion, and it's even worse than you implied. And here's why. One of the lines that I put in the October Deep Knowledge Investing Monthly Letter, it went out today, was to talk about President Reagan's line that there is nothing as permanent as a temporary government program. And so what we see is spending always goes up. And in counterintuitive inflation, I have a ton of long-term graphs for government spending on a variety of programs. And that there's always this talk about, oh, these evil people in Congress, they cut spending, they slash. Well, go look at the charts. They didn't cut anything. They didn't slash anything. Nothing gets cut. In Washington, simply spending at a slightly slower increase is viewed as a spending cut. It's not a spending cut. They're spending ever more every year. And so let's go back to 2008. And President Bush, and he first had a Republican Congress, then he had a Democratic Congress. But together, whether it was President Bush with the Republicans or President Bush with the Democrats, he was a big spender. And then we got to the end of his term and we had the TARP bailout. And you remember then President Obama talking about $1 trillion of shovel-ready projects. So we're authorizing trillions of dollars of excess spending. By the way, I'm still looking for where these projects are. I don't think any shovels got put anywhere, and I don't think anything got built. But then what happened? President Obama, for the rest of his term, I think ended up running up more debt than all presidents before him. Now, for anybody who thinks I'm blaming Democrats, he at times had a Republican Congress, and Paul Ryan, who had a reputation as a sharp pencil fiscal conservative, he signed up on these. Republicans were complicit in this. This is not all on President Obama, who was too big a spender, and it's not all on congressional Democrats. Republicans assisted them. So then what happens, right? President Trump comes in and he takes the crazy Obama spending levels. And remember, the Obama spending levels were based off of a baseline that included extraordinary trillions of 2008 spending. And then he spent more. And then we get to COVID. And we had the Congress spraying massive amounts of money into the economy. And now what we see is Congress has said, okay, great. We're going to take this extraordinary spending. Now that's a new baseline. And now we're going to overspend by $2 trillion a year. And the reason that number doesn't scare people as much as it should is because they're thinking, well, we're already $33 trillion in debt, $250 quadrillion total liabilities. What does another $2 trillion matter? Why do we care? And it doesn't really affect me, except it does. It affects you every time you fill up your car. It affects you every time you heat your house or go to the supermarket. These things are being paid for in inflation. And both parties in Congress have made it crystal clear that whenever we have an emergency, we will have emergency spending related to it. And then that will be the new baseline. Spending always goes up. The currency is always debased. There's no one in Washington other than maybe Rand Paul who's even talking about or considering reversing that. So unfortunately, I think you've asked the right question and the answer is worse than even you implied.
Well, that puts me in good spirits.
Yeah, sorry.
All right, let's bring it down to asset allocation, investment ideas on this. So I don't think anybody would disagree with anything that you said. I would go back to we don't choose the cards we're dealt, we choose to play the game. So how do we play the game?
So there are a couple of ways, and that's the right question. And I'm really glad you brought that up. One of the mantras of deep knowledge investing is we're going to roll with the changes. There's no whining. I have no desire to be whining. This is a good market. It's a bad market. Shut up. Who cares? Right? Good market, bad market. It doesn't matter. And by the way, Michael, this isn't, you're rules based, right? Your perspective limits what you can do. I'm not rules based. And so we have the ability to make money in a good market, in a bad market, in an inflationary market. And so what I see coming is more fiscal stress, more government spending, more inflation. There are a variety of ways to play that. One company I like right now is Innova. The ticker is ENVA. They are a non-prime lender. They report earnings later this evening. Hopefully, I won't look like an idiot in a few hours, but they're well positioned to benefit from the current environment of lots of consumer spending and very high employment, very low unemployment. Another place where we're finding a ton of value is we have huge positions in energy. Just imagine where oil would go in a more inflationary environment as dollars become worth less. That's something worth looking at. We have huge positions in uranium. The world needs more energy, and that is going to be the cheapest, cleanest, most reliable long-term option. And spot uranium is very cheap right now, and the world is running at a deficit. We're using up something like, it's a huge number of excess uranium usage versus worldwide production. And so nuclear plants in the next few years are going to have to be scrambling to find fuel, and they need to do that because they're not going to be able to shut down. The final thing I would add is you always have the option to hedge. And so right now, my book is very heavily hedged. I have short positions against market equity indexes. I'm long volatility. I own gold. I own a lot of Bitcoin and a lot of GBTC. Deep Knowledge Investing subscribers were buying GBTC at 14.5 in, I think, June. That's right around 26 today. That's worked out really well. I like Bitcoin long term, and I own a tiny bit of silver. That's a tougher market for me. That's like a 1% position. I don't see silver getting much larger. But the point of all this is, even in, and I get it, so much of what I've said today is really negative. And the best message that I would give people is you don't have to feel negative about this. It's okay to look at the economic situation as it is, as it exists, and say, okay, I don't like this, but I can make money from it. And there are ways to hedge your portfolio, hedge your gains, to make money from a bad market, and to position yourself so that you can do well. Now, will it fix the problems for the country? No, none of us is emperor of the United States. And so the best we can do is limit ourselves to being fiscally responsible and taking really good care of our own portfolio and not giving in to depression or malaise, and just always looking for a way out and a way to make things better for yourself, for your family, for your neighbors. And in my case, I'm looking out for the deep knowledge investing community and trying to make sure they're all making money, even in a bad market.
So, Gary, where do people get access to that research, and how do people find more of your work?
Thanks, Michael. I appreciate it. So the website is Deep Knowledge Investing, investing.com. There's a subscription button there. You're more than welcome to come check us out for a month, for 6 months. There's also a free option if those are not going to get the portfolio updates, but you'll get a sense of what I'm thinking on the macro side. And then, Michael, if you don't mind a commercial for your end of things, for anyone listening to this, if you are a registered investment advisor with $50 million or more of assets under management, reach out, and through Tidal, we can arrange for you to get a premium subscription for deep knowledge investing at no cost to you. And you'll also get a private conversation with Michael Gayed at no extra charge, which I think has huge value.
No one wants to talk to me, man.
I do.
Because people cannot differentiate between me and my own strategies. I'm just talking to anybody that's willing to listen. I appreciate those that did join and are listening to this conversation. Again, folks, please make sure you follow Gary Brode. I'm going to have this as an edited podcast. I've got a number of spaces coming up in the next coming few days here. Hopefully, I will see you all as those go live. Thank you, Gary. Always a pleasure.
Thanks, Michael. And if you don't mind me taking one of your lines, you might all be fucked, but your portfolio doesn't have to be.
If you understand this. Thank you.
Thanks, Michael.